Billions disappeared. How did this happen? A bank built a shadow world. It called itself legitimate. It operated in 78 countries. On paper, it held roughly $20 billion. In practice, the money moved through layers: shell companies, secret U.S. bank ownerships, correspondent accounts, political protection. Its name was BCCI. It grew fast. Branches opened from London to Karachi to Panama. Local banks accepted its checks. Big banks cleared its payments. Regulators saw only fragments. The bank showed legal charters. It showed audits. It hid the owners. The founders made a choice. They obscured who really controlled the bank. They used trusts. They used nominee directors. They bought U.S. bank charters through front companies. They courted presidents, ministers, and oligarchs. They offered safety where other banks could not. That choice turned money into influence. It turned a commercial ledger into a political lifeline. Growth accelerated. New accounts arrived. Deposits flowed. Loans went out. The bank became an instrument. It financed infrastructure that never appeared on public ledgers. It underwrote regimes. It shielded families. It moved funds for arms and commodities. Every new client was a new point of leverage. Every new jurisdiction was a new hiding place. Risk 1, concentration. Risk 2, secrecy. Risk 3, political cover. At the front desk, an eager branch manager opened accounts by the dozen. His bonus depended on them. He bought a new car. He rented a bigger apartment. He trusted the bank's network. He believed the brand. Months later, his customers' accounts vanished behind international freezes. His bonus disappeared first. His mortgage came next. Forensic economists started to map the mess. They rebuilt ledgers. They traced payment chains across correspondent banks. They used timing analysis to match inflows and outflows. They linked shell company filings to nominee directors. They found the same beneficial owner hiding under different names in 3 jurisdictions. Decision 2. Hide ownership in plain sight. Use layers of companies with no real activity. Use small banks in friendly states. Use correspondent relationships with big international banks to move money without questions. That was the playbook. Warning signs multiplied. Audit reports were inconsistent. Emails showed unexplained instructions. Transaction patterns were odd. Large sums moved overnight between unrelated subsidiaries. Banks in New York flagged clearance items that never added up. Regulators in one country opened files. Regulators in another closed them. Diplomats argued. Companies hired lawyers. A new risk emerged: regulatory fragmentation. Different countries had different rules. Information did not flow freely. The bank exploited that gap. The more jurisdictions involved, the harder it was to see the whole picture. The $20 billion on paper looked legitimate to any single regulator. Taken together, it was a house of cards. Momentum built for the investigators. Prosecutors assembled a cross-border task force. Auditors from 3 continents compared notes. Private forensic teams reconstructed transaction timelines. They found clusters of accounts tied to the same managers. They linked funds to offshore trusts owning U.S. banks. Those patterns suggested deliberate concealment, not error. Then the risky choice: use covert tactics. Traditional subpoenas risked warning the bank. Bank managers could move funds in minutes. The task force needed a sweep that would seize control at the same instant worldwide. They needed principals in one place, at once. The turning point came in an unlikely form. Investigators staged a wedding. They created an event under a shell company's name. They mailed invitations. They booked a hall. They set a guest list designed to draw key figures into a single room. An undercover agent took the role of the groom's friend. Another posed as a financial advisor. Cameras and documents were in place. The goal was simple: get the people together, then strike. Call to action. Demand public registers of beneficial ownership. Transparency works. On the chosen day, teams moved. Simultaneous raids hit offices, branches, and private homes in multiple countries. Bank computers were seized. Safe deposit boxes were opened. Legal charters and nominee filings were collected. In the ballroom, plainclothed agents quietly observed as officials and bankers arrived. Some were detained, some fled. International asset freeze orders followed within hours. Consequence 1, $20 billion in assets were frozen or seized. Correspondent accounts were blocked. U.S. bank charters held by the network were revoked. The global web unraveled. Papers that had shielded ownership were exposed. Courts issued injunctions. Banks faced civil suits. Governments demanded answers. The fallout hit ordinary people fast. Depositors in remote towns could not withdraw savings. Employees found payrolls halted. Businesses collateralized to branches suddenly discovered their loans were unsecured. Markets felt the tremor. Stock prices dipped for banks with unnamed exposures. Credit lines were withdrawn. Political patrons lost funding. Projects stopped. Bridges, hospitals, and contracts stalled amid lawsuits and subpoenas. Human story. A factory owner in a provincial city had used BCCI for payroll. He had trusted the branch manager he knew personally. One morning, the bank teller told him the vault was closed. The factory stopped. Workers went home. Families tightened belts. That is the immediate cost of hidden finance. Human story 2. A regime official found his foreign accounts open for investigators. Promises of protection evaporated. Power shifted. Deals renegotiated. Loyalties turned into liabilities. Forensic teams kept working. They reconstructed ownership chains through tax filings, shipping records, and personal correspondence. They used timing analysis to show how funds moved in anticipation of seizures. They matched invoices to shell company names. They used sworn depositions to pierce nominee shells. New consequence: prosecutions across 78 countries. Asset recovery efforts stretched for years. Trustees and receivers fought in courtrooms from Nassau to London. Some assets were returned to creditors. Others were tied in litigation for a decade. The cost of recovery often approached the size of the missing funds. The legal mess created winners in law firms and losers in creditors and depositors. Another risk revealed: the velocity problem. When a network like this collapses, assets move faster than laws can respond. That is why coordinated, simultaneous actions are necessary. The staged wedding was not theater for its own sake. It was a tactic to freeze movement and preserve evidence. Consequence 2. Regulatory reform. After the seizures, lawmakers in multiple countries passed new rules. Beneficial ownership registers were created. Banks were required to report unusual correspondent traffic. Audits were tightened. The opaque trusts that once hid owners grew harder to use. But reform had limits. Some jurisdictions resisted. Some legal loopholes remained. Secret wealth simply migrated to new structures. The cycle began again in other forms. The lesson was clear: secrecy is adaptive. Human impact kept surfacing. Whistleblowers who had tried to warn authorities were vindicated in court, but ruined in life. Some lost careers. Some received settlements. The whistleblower in one country testified that internal reports were ignored until international pressure forced action. Another former employee watched as the men she had banked for were arrested on television. She felt relief and fear at the same time. Investigators learned to blend skills. Accountants worked with intelligence analysts. Lawyers coordinated with diplomats. Forensic economists translated ledger gaps into sovereign risk. They showed how a single bank could be a covert state instrument. New decision: banks and regulators must choose transparency over convenience. The price of convenience is systemic risk. The price of secrecy is human cost. Years later, the legacy of the collapse is mixed. Some victims recovered funds. Many did not. Some reforms stuck. New schemes appeared. The lesson remains urgent. Final lesson: secrecy enables power. Forensic economics can unmask that power. Ledger forensics, ownership reconstruction, timing analysis, and coordinated enforcement can dismantle a global web. But they require political will, international cooperation, and the public demand for clarity. Demand public registers of beneficial ownership. Insist on transparency in the banks you use. Ask who really owns the companies you do business with. The bank vanished. The holes it left are still visible. The money that disappeared became evidence. The staged wedding became proof that sometimes theater is the only way to hold power to account.